How do tax write-offs work for a small business? Hi, my name is Nicole. I'm a tax advisor at Robert Hall and Associates. Today we're going to talk about how do write-offs work when you have a small business. It's totally understandable. People use this word all the time and you're like, what does that actually mean? Well, I'm going to tell you what write-offs actually mean in layman's terms. I'm going to talk about some common write-offs that people have and some ones that you should look out for to make sure you're including. And then how do you stay compliant when you're taking write-offs? Do different write-offs require different record keepings, or what do you need? Is a bank statement totally fine? Do you have to take a copy of the receipts? What do you need so that you can stay compliant and you are prepared? As always, please make sure you like and subscribe so you don't miss out on any of our upcoming videos. All right, let's get into it. What is a write-off? A write-off is an expense. It is a business expense that you are deducting from the income. When you have these expenses, you're taking your income, you're subtracting the expense, and that's how you get your profit, and the profit is what is taxed. And so if I have a business and my business is selling t-shirts, and I made $100,000 this year selling t-shirts. Congratulations me, first year in business, woot. And I spent $20,000 on the fabric. I'm going to take my 100,000 and I'm going to subtract the 20,000, and that's 80,000 of profit because the 20,000 is a write-off. Hey. Can I subtract my own labor because I spent 80 million hours making the t-shirts? No, that's not a write-off. That's not a deduction. Can I subtract the contract that I thought I was going to get, but the fabric company didn't get me my fabric in time, so I lost out on the contract with Target? No, you're not going to be able to use potential income or potentially lost income or lost potential income as a write-off. You can only use money that has actually gone out of your account. Now, it's very important that you understand how your bookkeeping is managed. What is the accounting method that you are using? Are you on the accrual or are you on the cash basis? Accrual, which isn't super common, but it does happen. Accrual is really great if you have a seasonal business. And accrual means that you count the money that is not actually received, but the money that should be received. So if I do work for somebody, but they haven't paid me, I can go ahead and count that income even though I have not received the money. If I'm a cash basis person and I did work for somebody and they haven't paid me yet, but they will pay me, I will only count that income once it's paid. And so the difference between accrual and cash basis is accrual, you count the money that's going to come in when you send out the invoice, when it's now potential income. And then cash basis, you count it as when it is received. You do the exact same for expenses. Accrual, you count the expenses that you know you're going to have. And cash basis, you count the expenses that are actually spent out. Accrual might sound cute for the beginning year, but it does require a little bit extra bit of bookkeeping because at the end of the day, it will flush out. Don't think like, oh, I'm going to tell my contractor that I'm going to pay him $100,000 so I can take it even if I don't pay him $100,000. Eventually it will catch up to you. So if you're on accrual and you do take that $100,000 deduction and it never comes out, you do have to count it back again. And there could be some penalties and things. There's a whole bit of tracking that happens. So it's not a way to save on taxes by switching to accrual. It's just, is it easier for you to track those expenses? And usually in accrual, people have they don't operate on a calendar year. They operate on like a fiscal year or their own whatever year it may be. Okay, so let's talk about what are some common write offs for small businesses and what are some ones that we need to make sure that we have. Common ones that you're gonna have. We've got technology, equipment, a computer, a phone. If you needed to purchase like a TV, if you have like a waiting room or if there's a TV in your office, any type of equipment that you have, that's all very, very common. Sometimes people feel a little hesitant about taking equipment because they say, like, hey, I also use it for personal, because who's not going to use their laptop or their iPad for business and personal? No, you can go ahead and take it. And depending how you're structured will determine how much of that expense you're going to take. And so, for example, if I'm an LLC and I spent $10,000 on equipment and I'm using that equipment for personal and business, and I use that for personal 60% of the time and business 40% of the time. And so for in that case, I would take $4,000 of my equipment as a deduction, a write off. I will write off $4,000 of that equipment. If I'm an S Corp, most cases take the full expense as long as I'm using that a piece of equipment for 50% for business, at least 50% for business. If you are a C Corp, it's the same idea as the S Corp, and you'll be able to write it off. Let's talk more about the other types of common expenses. So we've got equipment. Of course, there's your car. A car is one of the greatest expenses that everybody has. I'm here in California. Californians love their cars because we're on the freeway so much and they're expensive. So you've got that great deduction or write off like your car. Depending how you pay for your car will determine how much you can deduct of an expense, how much of a write off you'll have. And so, like, for example, if you're leasing your car, you're only going to take the payments that you actually made. If you purchase your car, regardless of financing it or buying it outright, like cash or whatever, you're going to depreciate it over time. Meaning, depreciation means you take the full cost of the car. And so, if I bought it for $50,000, I would spread that expense over 5 years. I don't want to get into, can you take more up front because of Section 179? Yes, there's all these tricks and things that you can do. Also, it's important to know that if you're on just a sole proprietor or you're not like an entity or anything, you can take a car expense as just miles, and they'll average based on whenever this is, they'll take 63 cents for every mile that you drive. And so you would track your miles, you wouldn't track your expenses. Actually, to be fair, you should track both your miles and your expenses so that your accountant or your tax advisor will be able to see which one is more advantageous. If you're not like in an entity structure, you want to make sure that your miles is a bigger deduction or a bigger write-off for you, or is it a bigger write-off if I include all of my expenses that I have for the car? And then you can determine, because you want to take the biggest possible. It's like, itemizing. Is it better to itemize or is it better to take the standard deduction? Well, it depends on how many deductions you have. If you add up all your itemized deductions and it's lower than the standard, take the standard, because you want more deductions. That's on the personal side. Okay, so we've got equipment, we've got your car, that's also a great expense. Another really important expense is marketing and advertising. Marketing that people do in this day and age it's actually kind of blown up, this expense, because people are operating online and in real life. Yeah, and so in real life, people have an expense of marketing, and then you pay now differently, different platforms and all of these things for marketing to promote your business, to promote you as a person, etc. Some of the expenses that people forget they can include is business use of home. People usually remember that when they have like a really, really small business and it's just on a simple Schedule C. But business use of home also applies when you have a large business that's just not done as business use of home, but you can still get those deductions. I can still include the amount I'm spending on my Wi-Fi for my business because, I had to upgrade it to business Wi-Fi or business internet, whatever it's called. And, I can include that additional charge that I wouldn't have had because I am running my business out of my house. And there's ways for you to get those expenses in. It's not going to be a direct line item in expense. You're going to really need to sit down with your tax advisor to make sure they're including it and they can see the whole picture of it. When you have like a medium-sized business, you should always be sitting down with your tax advisor. That's just important for you. Another type of expense that people don't include is the stuff they're spending on the internet. And I know I already talked about the platforms you're using for marketing and advertising online, but this is a little bit different. This is for the Google Drives. This is for your Dropbox. This is for the Zoom subscriptions that you have. These kinds of small expenses that really are business. Why do you have a Zoom subscription for personal? Like you would have just used the free version. I think it's like an hour, like per thing, unlimited. You would just have a free thing, but because you have a business, now you pay for your Zoom subscription, and that's going to be a deduction. These smaller expenses that come out of people's account, a lot of times people do not count them or realize that they are, so significant, especially if your business is pulling in like 100 grand. You're like, okay, I end up spending like, I don't know what it would be, $120 on, my Zoom subscription a year. And then I spend, maybe $1,000 a year on my drives, like Dropbox or whatever. But when you add all of that stuff up, it does really help. And it's just money that you don't need to pay taxes on. So like, even if it's a little bit of money, why wouldn't you want to take the deduction? It's money you don't have to pay taxes on. It makes, obviously, great sense to use it as a deduction, but that's one of those types of deductions people forget. Another large deduction that people sometimes miss out on is salt taxes. And they don't miss out on them, but they don't understand ways to get over what we call the salt limitations. And a salt tax, the word tax is actually a little bit redundant, is state and local taxes. That's what SALT stands for. And so property tax, income tax that you pay to the state, sales tax, all of these are SALT taxes. Now, this is normally done on your personal side, your SALT taxes. And your SALT taxes are capped at $10,000. If you live in a high state tax state like myself here in California, SALT taxes you exceed your SALT taxes by $10,000 so easily. Like month 4, I'm over my 10K in SALT taxes. And so if you have a business and you live in a high state tax state, then there are ways to get those deductions in, especially if you have a business. It's called a PTE. It is a pass-through entity credit that you are able to do your business pay some of your SALT taxes, and so that you can take it as a deduction. Okay, so we've talked about the write-offs, what are just expenses that you have for the business. We talked about some common ones. We talked about your vehicle, advertising. We've talked about ones that you need to make sure you're looking out for, including business use of home regardless of how you're structured, and then also making sure you're getting those smaller expenses. Let's talk about what are some kind of the bad expenses. Now, I need to be very, very clear here. Bad expenses do not mean do not use them. If they are a business expense and you have them, yes, use them. Just be cautious about them. Bad expenses are things that go in your mouth and on your body, like food, clothes. It wouldn't be called clothes. It might be called wardrobe, or uniforms, depending what industry you're in. Makeup. Yes, makeup can count, like if you're an artist or if you're a content creator or a model. Yes, makeup can count, but there's very specific ways for you to be able to make sure it is counted. And so I'm not saying everybody has meals as a deduction, because you always are going to have business meals, but you just need to be cautious about how much of an expense, how much of a write-off you're taking in these types of categories. And then also make sure your record keeping for these categories are really on point. So that brings me to, speaking of record keeping, let's talk about it. Record keeping. People think, is it okay for me just to have bank statements, or should I keep track of receipts? It really depends. I know that's annoying for you to hear, and accountants love to say it, but it's 100% true. It really, really depends on what type of deduction we're talking about. Record keeping is important because you need to prepare that somebody might come around one day and ask questions, i.e., an audit. If your record keeping is good, then there's no real issues. Electronic is your friend. That means we don't want to do things in cash. That means we don't want to really write everything down. You really want to make sure all transactions happen electronically. Keeping track of invoices make it really, really easy. And in terms of receipts, taking pictures of receipts, uploading them to a drive just as a huge dump is totally fine. If you get audited, you don't need to sort for the auditor. That is not your responsibility. It is your responsibility to provide them information, and if you do a big dump on them of information, then fine, that is okay. In terms of like the receipts, take a picture, upload those pictures to a drive. As I said already, you can dump it on the auditor. It's not your responsibility to organize that stuff. Obviously, if you are being audited, you really need to be working with a tax professional. You representing yourself is like a doctor trying to do surgery on themselves. Like, what are you doing here? Like, you need a non-emotional voice to represent you. But in terms of record keeping, pictures for receipts are really important when you have large transactions. Bank statements at this moment in time are not sufficient. You'll need something in addition to the bank statement. However, if they're concerned about gas, for instance, the bank statement is going to be part of the proof, but a receipt is not going to be the other part, because that's not what they're going to be having an issue with about the gas. They're going to have an issue about, did you use it on business? And so a log or explaining where you had all this gas spent to is going to be more important, which you can make sure you are creating, or it gets created. So it's not necessarily all about receipts. Large transactions, thousands of dollars, I definitely recommend people having receipts. Just taking a picture, uploading it to a drive, and titling the folder 2023 for the whole year. Like, that's amazing. Another thing that you can do in terms of record keeping is making sure you're identifying why it was a business transaction. Why is this a write-off? Why does this count? How is this an ordinary and necessary transaction? You need to know that, because that is how you defend yourself when you are being audited. The other and last little bit is making sure you're not too aggressive or not too conservative, because we don't need to pay more tax than our fair share. We don't need to pay more than that. But you also don't want to be too aggressive where you're just going to present more problems for yourself in the next few years. You need to make sure you're keeping your records for about 7 to 10 years. Sometimes people do encourage people to keep it a little bit less. I would say 7 to 10 years. I say back it up electronically, throw it into a drive or something, and then forget about it until you need it. But keeping track of why things are an expense and when that expense happened. The when is going to be done with the bank statement, so that you don't even need to really think about. But why it's a business expense is going to be really, really keen and important. Oh, sorry, I already said it was the last, but this is the last. 1099s. When do you send out a 1099, and what do you do for people that are contracting in? Record keeping for these people is going to be specifically 1099ing. It's a great way to keep track of the expenses that you gave to these people. They might dislike it, but you should do it. And then also understanding their invoices, having them send you something so that you show why you are spending this expense. An invoice, a quote, an email with the invoice attached. All of that is sufficient. And then make sure you save it, throw that into the drive, and you should be good to go. If you have more questions, we are here for you. There's a link down below in the description box. Please click it. You can set up an appointment with me or one of my wonderful and amazing colleagues. All right, I will talk to you guys later.